Good morning, MarketChameleon. Is everyone joining us for the first time? Thanks for coming by, checking out the pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good.
Well,
You want to start with a disclaimer? Yep. I'm here.
Good morning, everyone. Before we get started, keep in mind, Will and I and MarketChameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
All righty.
And let me share my screen. While I'm doing that, if anybody is joining us for the first time, we do this show in the mornings to help answer questions about MarketChameleon tools, data analytics. If you want to ask a question, there's a link that we provide on that YouTube chat. If you click on that link, it takes you over to Zoom. And once you're in Zoom, there's a button at the bottom, raise your hand. Click on that. You don't have to turn on your video camera. Once we let you in, you could ask your question live and direct. Everybody could hear you. If you prefer to type in your question, you could put that also on that live chat box on YouTube. Will's watching it, and he'll read the questions back to me. While we're waiting for people to put in questions, what we'll do is start out taking a look at the pre-market report to see what's trading at pre-market hours, get some insights from there. If we don't get questions coming in, we'll navigate to a different part of the website, or take some questions that come over through our emails or chat, and maybe try to talk about those. Okay.
Also, we have a webinar tomorrow, right? Option strategies to hedge downside risk.
Yep. So tomorrow we're going to have a webinar with Interactive Brokers. You have to register with Interactive Brokers. They're hosting it. It doesn't go on YouTube like these. So you have to register for it. It's going to be tomorrow, I believe. Is it 2 o'clock Eastern? Well,
2 o'clock.
2 o'clock Eastern. So you have to go, in that link, register for it, and you could join us, and we'll talk about different strategies to hedge downside risk. So if of course, one way is just to buy puts, but there are other ways to strategize and hedge your downside risk. And that's what we'll do, is just go over different types of strategies and outlooks on those strategies. So let's start out with the pre-market report, Will, and then we'll take any questions that come over. Okay.
Perfect.
And so this is the pre-market report. It's a list of stocks that are trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 99 stocks made our percentage gainers list, 284 on a percentage decliners list. So from this perspective, we're looking like a bearish bias at the open. And when you look at this list, you'll see lots of stocks that are small cap stocks. There are ETFs in there, leverage products. Got some, it could be a right or a unit trust, anything that's listed on a major U.S. exchange. If it's trading at pre-market hours and meets our thresholds, it can make this list. So we do want to filter down this list to a smaller group of stocks that's a little bit more focused, to get some more insights. And before I do that, I think it is worth mentioning that we do see these regional banks right now on the decliners list. So I think, that's now spilling over from the bank that was, I guess it wasn't bailed out, but the depositors, right? What was in SVB? The depositors were basically guaranteed to get their deposits back. It doesn't matter if it was insured or uninsured. At this point, everything seems to be insured at all banks, you know, across the board, right? Well, and
Yeah, and the Fed has opened up the window again to accept bonds, so you can, you know, if banks need cash to meet redemptions.
right. And
So for those who are unaware, this bank collapsed because, well, for the first thing they did is they had to sell bonds that were on the books and realize the losses in the interest rate moves with the 10-year bond that they had, and to meet withdrawals, right? And that just escalated withdrawals, that,
right.
you know, $2 billion loss or whatever from a bond sale.
Right.
And because they couldn't go to the Fed window with those bonds anymore.
Right. So, and essentially what they have is duration risk. They basically, they're holding long-term bonds, and those bonds will fluctuate. They could go up or down based on where the interest rates are, because that's what the prices, market prices, are sensitive to interest rate moves. And I think that, you know, why we're waking up to a world like where there's more uncertainty is if they're going to basically now insure all deposits, you know, uninsured, everything's guaranteed, insured, uninsured, it doesn't matter. They're going to guarantee it, which probably in a short time, they only had a weekend to think about it. It was probably, you know, maybe it was even a smart move to do to prevent more contagion and more panic from withdrawals. But then the question becomes, we have to rewire our entire financial system, because now we got to rethink it, right? Like,
wait, I thought we did that in 08.
Yeah, and now we just did it, yeah, and we're doing it again. Because at this point, you know, if that's the case, well, then, you know, the implicit guarantee you have with the big banks now, it just applies everywhere, right? So it's not just the big banks. Everybody is going to be safe putting in deposits into the banks, but it's not going to be free, right? And what is the political consequences of it? What do our banks look like? Are they nationalized? Are they basically government entities where they're going to have to do the government's, you know, whatever the government says? At this point, the government is going to have to regulate the risk, right? Because banks, that's what they are. They're risk assets, right? It's in the business of risk. So if they're in the business of risk and the government guarantees that risk, then the government has to regulate it. The government's going to manage and tell the banks what risk they could have on, what they can't have on, and what does that mean for shareholders, right, of these banks? What does it mean for CEOs? What does it mean for management? What does it mean for people who are getting paid a lot of money to basically, you know, trade this risk and manage?
Yeah, you can bet the CFO of the bank, and I heard the CFO actually had been a high-level executive at Lehman Brothers as well.
Yeah.
And you know, I bet that individual has been making millions of dollars yearly for years.
Yeah.
And totally mismanaged this move in interest rates, right? I mean, that was part of their job as risk management.
Yeah.
And to know on your books you have a lot of duration risk and not take any of it off or enough off is a problem,
Yeah.
right?
These banks have, and we were talking about it, the hardest thing to do with a bank, and that's why how do you price a bank? Just like an insurance company, you don't know really what their risk is. It's like not possible to dissect it all. Even you see balance sheets and you see assets and you see, but the real risk under the hood is very hard to ascertain. It's like you don't know what these contracts are. They have counterparty risk, duration risk, they have withdrawal risk. All this stuff could hit. And by the way, their risk was not unreasonable, right? It wasn't like they were holding government bonds, right? They were holding government bonds, but what happened was that people were withdrawing money from that bank, SVB, much faster than people anticipated because of a downturn in the economy. So a lot of their depositors were burning cash and needed to access that cash. So they were just it was like withdrawal, right? It was like the speed of withdrawal was really what started to the outflows of cash became much faster than the inflows.
Yeah.
And
I was unaware of this, but Etsy, all their merchants had to process through SVB. So you can imagine, Roku, I think all their accounts. I mean, Roku had like
a quarter
$400 million
right
books or something in the bank.
Right. So there's and that was, I guess, and by who until these things collapse, nobody even knows. It's like all under the hook. It's not even visible, or you don't think until it hits. And these banks are like that, and these big banks are J.P. Morgan, Goldman Sachs, Bank of America. Their CEOs don't know what the risks are, and they're so complicated that even the Federal Reserve, if they went into these banks and try to understand all these different contracts that they have on and the interrelationships and risk, it's impossible to tell, right? It's like you don't know for sure, what the risks are in these banks and like what could trigger a catastrophic, meltdown in these things. They just think they know. But the tools that they're using, it's just, too much uncertainty, right? And now I think what's going on is and pretty much I don't think you could go back, but if everything is insured, that means that the taxpayer is really on the hook, right? Maybe not in this case, but the implication is that we are all on the hook for this financial system. We're insuring everybody, right? We're guaranteeing. So that money has to be somewhere, right? And if that's the case, are banks and financial institutions becoming like, government entities?
Are they a utility basically?
Are they a utility basically? Because at this point, that means that if they're backstopping these banks, then they have to really go in there and approve of all the risks that they're taking, right? They can't just let them go to town on risk and saying we got you covered. I don't think that's going to fly with anybody going forward, especially this is going to have political implications. Maybe not today, but it will. And that's why I think for shareholders it's a big question. Well, what am I even holding here? What am I invested in? In this, and it gets really confusing. And then with these big institutions, Goldman, JP Morgan, what is the implication there? Because I think now you're going to have a complete rewiring of the financial system and rethinking, right?
It's amazing that that's happened in 3 days, huh?
Yeah, how fast?
Two trading days. I mean, we started talking about this on Thursday, and then 2 days, and then the weekend, and now it's not even a third trading day, and everything's changed.
Right. Everything's changed all of a sudden. So
how do you fight inflation in the face of this now?
Right. And what does this mean for inflation and interest rates? So I think maybe if we don't have questions, I'll talk a little bit about that. But let's see how, a smaller group of stocks in the pre-market, what we'll do is filter down this list just for demonstrations. So smaller group of stocks, and I'm going to use the filters here in ETF. Let's bring it down, and you see that this filter has a list of ETFs. Some of them are sector ETFs, broad-based ETFs. So I'm going to pick SPY, which is the S&P 500 ETF. And when you do that, you see the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we do see 2 stocks made our percentage gainers list, 87 on the decliners. So from this perspective right now, we're looking like a bearish bias at the open. I guess if there are no questions, maybe what we'll do is talk a little bit about inflation. You want to do that?
Yeah, perfect. I mean, Rob made a point. I don't know if it's something you want to touch on. He said if they're guaranteeing all these accounts, he feels like a lot of money will flow out of corporate bonds and stocks and into CDs at banks. Is there a, I mean, the
Yeah,
thing is,
well,
for me, I think they're going to push interest rates lower and maybe the market starts to look more attractive, but who knows?
yeah, we'll see. We'll see how this plays out. Does that mean that, on the one hand, if the banks, do the banks then, offer higher interest rates because they could take riskier bets, or, are they going to get, or maybe they don't need to, so far they haven't been increasing interest rates, right? So the deposit rates have been below where the Fed funds rate is for sure, so they're not anywhere near there. But potentially, maybe they can't raise it, right? These banks maybe are going to be in trouble if they try to raise it because, if a lot of them are holding these long duration bonds, and they start raising the interest rate on all deposits across the board, they're going to start losing money, right? So maybe they even can't raise it. I don't know. But yeah, we'll see how this plays out because I don't think we heard the end of the story. Is it just, all deposits at this point are insured and nothing to see here?
Yeah, well,
Eventually that's a political question.
Lauren asks, how can the Fed continue to increase rates now?
Right. So now the question is, well, will they increase interest rates to fight inflation, or are they going to slow down and let the market settle? We'll see what I mean, for sure, we don't know. They're probably discussing this right now, right? They're all huddling together and they're having those discussions themselves. Because there's no right answer. They don't know. They don't know the right answer. The Federal Reserve, they testify. Powell testified. I don't know what the right interest rate is, right? He has no idea. He's just doing it, and trying to look at the data, but he doesn't know if the right interest rate is 6%, 5%.
He's watching the data.
He's watching the data and trying to react to it, but he has no idea, just like the rest of the market doesn't know. So they don't know what to do. They're just trying to, smooth things out along the way. And we don't know, there's going to be a little bit more data coming out before their meeting. So I think Goldman Sachs said they're not going to raise interest rates, but I think JP Morgan said it's going to be 0.25%. Some people say they should stick to the fight on inflation. So there are varying opinions here. I don't think there's a consensus, and I think that the Fed themselves are not sure what to do. Probably, they try to meet things in the middle. So, probably not 0.5%. That might be off the table. Not doing anything. Potentially like stopping and then waiting. Or maybe going 0.25%. Like usually they try to do something in between. But when they fight inflation, and here's the issue, where's this inflation coming from, and how effective are their tools is another question, because I think everybody that you listen to, they always say, well, I think the interest rate is going to peak at 5.5% next year, and then we're coming down, inflation will be done, or, instead of 6 months, it might be 8 months, and then they're going to lower it. But nobody really explains to you, well, where's the inflation coming from, and is it really fixing? Like, how did you even come up with this number? How did you come up with this opinion? Just people throw out opinions, right? And I think one thing is important to understand, well, where is this inflation coming from? It's not really being driven by oil prices. It's not being driven by like housing bubble. That's not what's driving the inflation. The inflation is driving those things. And like before I show you this, I'm going to put it here. People try to ask me to simplify things, so I'm going to try to simplify it as much as I can, or at least how I think of it. And to simplify, you kind of have to keep a lot of other things constant. And the economy, it's a complicated thing, right? It's a complicated thing that has a lot of all these millions of different relationships. But let's see, let me copy this. But I'm going to try to keep everything else what happened? I'm going to try to keep everything else constant for now, just to demonstrate to you what I think happened in the last 2 decades and what is happening now, that's pushing on this inflation, and that raising interest rates is going to help, but it might not really be enough to solve the whole issue. And when you think of the economy, I wrote this down. You've got, buyers, right? Buyers and sellers. That's how or to simplify things, right? And think of this, the sellers, right? So we got all these workers, millions of people working in here, right? Let me get this. We have millions of people. These are people, right? These are goods. So we have millions of people working here, contributing to this basket of goodies, right? So these are all the goods and services, right, in here. And these are all our basket of goodies that we could buy. That's what our economy produces. And these people here are producing these. So for every dollar of goodie they create goes in here, they get $1 back, and then they could go into this basket of goodies and buy whatever they want for $1, right? So if that, in the simplified world, if that was always the case, then it would always be even in balance, right? Everybody produces a good, then they get $1. They could go in there and get whatever goodie they want out of that goodie bag. And so what happened was, and there's other things going on here. So I'm going to come back to this over here. But if this grows, right, if this circle grows and this circle remains the same, but if this circle keeps growing, right, meaning these people are producing more goodies with the same amount of workers, that means our standard of living is going up. We call that productivity, right? So all of a sudden we're producing more. Our economy is producing more of these suites, and it's taking the same amount of workers. So now we have a lot more stuff to purchase with it. And that's productivity. It's deflationary. And that started to happen in the early, before 2000. It was really like a 3-decade of really fast productivity growth. It was spurred by technology, the computers, the internet, all this. There are people alive today that don't even know a different economy than that, because this circle kept growing, okay? Year after year, we had really good productivity with some hiccups, but in general, we had a lot of productivity. That's good, right? In addition to that, this bag of goodies grew even larger because what we call globalization. So what happened was mainly, let's say China said, hey, you know what? We're going to add to your basket of goodies, right? We're going to put in all these sweets in here. So they added a bunch of sweets into here and expanded our basket of goodies, saying you can pay us back later, right? So this created a lot of deflationary pressure, right? This has been going on for like 30 years probably, or 20 years, in combination. It just kept growing. So then what we have over here in the buyers is the following. We're like, well, this is deflationary. So how do we make this bubble bigger to balance it off, right? So a couple things. First of all, when somebody produces $1 of a good and puts it into this basket, they don't actually get $1 because they have to pay taxes, right? So they pay taxes. So let's say 25 cents. So for $1, they 25 cents goes to the government, 75 cents goes to them. And the government basically replaces the consumption. The government takes that 25 cents and they dip it into this basket of goodies. Okay. So here's what one of the problems started to occur is, how do I draw a triangle? Hold on. The buyer here are all the people in the economy. And the biggest buyer, the biggest single buyer of these goodies became the government. It's right now 25%. This, and I'm going to show you why this is becoming a problem. All right. And I'm going to show you, the evidence. So that's the government, that's everybody else. Right. And to expand this, they said, okay, well, what we're going to do is, how do we increase this purchasing power? Because there's so many, stuff in here to buy. What do? Well, here's an idea. Why don't we tell the person that you could go and purchase more than you actually have by taking out loans, right? You could take out mortgages at low interest rates. You could go buy cars, and we're going to make this bubble even bigger. So this way you could buy more than you earned, which is okay, as long as you pay it back, which means that you're buying more today, but later on you're going to buy less because you have to still earn and contribute to the goodies, but you're paying interest, so you're foregoing future consumption to consume today, right? That's right now where we're kind of at, with increasing this bubble, right? Because and then of course, other things contributed to it because of the pandemic. So they just issued people checks and lowered interest rate. The Fed did a lot of stuff. So this bubble really grew, right? And now so here's what happened. As this bubble grew, so did the government. And this part over here, let me see. Do people like this or not? Well, tell me if they
Love
don't.
it. Love it.
So right now, what's going on is that the government, the Fed, is saying, whoa. Here, there's a problem on this side. Productivity is declining right now, and this globalization is declining, right? This right now, we're seeing these two declining. The productivity, this and this declining. And the Fed can't fix that problem. They can't fix the problems on this side, right? Because deglobalization, if China says, okay, we're not expanding anymore, and that means we're not adding to your bag of goodies, right? Not only that, here's the other problem, because we have a trade imbalance. They might come in, China, and say, yeah, we have all these dollars. Now we want to dip into the bag of goodies, right? This is now creating inflation, right? If they do that, because now you got all these dollars flowing out here, and you got all these goodies, sweets here. Wait a minute, are we at 9:30? Should I stop?
We are at 9:30, yes, but I want to know, what are the goodies?
Right.
That's everything we consume.
Right. It's all everything we consume, everything we produce, right? And what China produces, whatever it is. But essentially, this is deflating, right? And they're trying to deflate this by saying, well, reduce your purchasing power. But the problem is that this here, the government, is not going to get reduced. what they're saying is we are going to continue to borrow, right? And be a bigger portion of the economy, the consumption. So look what's happening here. Let me show you guys. You see here, this is our spending, right? They're going to continue spending, dipping into the bag of sweets, but they're only bringing in this much, which means they're going to continue to borrow, right? They're going to continue to borrow to keep dipping in there, right? And this is how big they are. This is the government's portion of the economy, of GDP. Right now, they're here. So this is where they peaked at the pandemic. They went down, but they want to stop here, which becomes 25% of our GDP, which is very high. Like if you see it, if you look in history, we did that during the war, right? So this was during the war, 1945. The government had to become the biggest consumer to fight the war, but then they came down. And you could see here that this level here is a historic high, meaning that there's going to continue. They're not slowing down that stimulus that they provide, right? The government provides extra stimulus because, as we see here, this is extra stimulus, right? That's more than they're getting. That's more than they're getting from us, meaning they're still borrowing to purchase today, creating this inflationary pressure. So two things here that the Fed can control is that pressure and this pressure, right? Deglobalization. They can control productivity or the fiscal side of deficit spending. So that's why it's not very clear if they can actually bring everything back into balance without sending this economy into a deep recession. Anyway, I'm going to let you guys go. Try to create a visual. Some people ask me to do this. That's why to put it in the visual. So try to.
Yeah, no, that was awesome, D. Everyone was very appreciative of that. Great job. Remember, everyone, to register for Dimitri's webinar tomorrow with IBKR. I put the link again into the chat. Great job, my friend.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Great job, D. Trade and Peace community. Have a great day.